My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer America. Other people make friends, just try to make you some money. My job is not just to entertain you, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. At moments like these, it's easy to forget why we ever even liked technology stocks in the first place. Even if tech got a reprieve today, Dow gaining 347 points, the S&P climbing 1.50%, but the tech-heavy NASDAQ jumping 2.28%. One after another, I'm hearing people trash tech, making it clear that they want nothing to do with almost anything in this sector, not just the semiconductors, and that this entire move this week, which you know I've liked, is a selling opportunity. Sell. I get it. Most tech stocks have been absolute disasters. Hey, the whole year, much worse than the already bad averages. Now, though, when we're finally getting some really serious downgrades, price target cuts, and critical commentary, it's important not to get carried away with the negativity. What we need to remember is why we like tech to begin with. We do know that in a slowdown, less money will be allocated to technology. We know the valuations got too high last year, in part because of the excess liquidity in the system, but also in part because many of these companies were wildly over-earning during the pandemic, and it was really hard to tell that they were. But to throw in the towel now on stocks like NVIDIA, which I hear people doing, which has fallen from $346 to $158, or AMD from $164 to $79, that seems awfully extreme. They weren't worth what they were selling for back at their highs, but do they really deserve to be worth as little as they are now? First, though, I need to back up and explain what went wrong, what fooled so many people, including yours truly. Put simply, we confused the one-time only purchases of tech by individuals at the height of the pandemic with some sort of new secular trend that could last forever. We didn't understand the work-from-home pivot, which was entirely one-off. We didn't understand the play-from-home wave either, so we extrapolated computer and gaming equipment sales and misjudged both the volume and velocity of what was really needed. Now, before I get too critical, nobody saw mass work-from-home coming, and nobody knew when it would end. What looked like an ephemeral trend then lasted long enough to seem like a universal trend. But now it's feeling like an uneven, sporadic trend. In that bizarre scenario, who knew if every house would need a new heavy-duty PC, cell phone, game box, and headgear, or just 40 million homes, or maybe 60 million homes? Who would need it? Would it be 330 million Americans or 33 million Americans? Hey, what would the Chinese do? Would they need it? How about the Europeans? No one knew. Then we had 3 waves of COVID, and everybody from Walmart to Target to Amazon went from thinking that this work-from-home thing can't last for too long to thinking, well, we're going to work from home forever. So who knew how much hardware to buy or how many warehouses to rent or how much tech-heavy infrastructure was needed to meet demand? The whole chain didn't know. Everybody from top to bottom. It was an inherently unpredictable situation, and many companies flat out guessed wrong, including huge outfits like Amazon that usually have uncanny instincts buttressed by artificial intelligence insights. Into this vacuum, we saw the success of Roku, Zoom, DocuSign, Etsy, Shopify, and so many others that seemed like great secular growth stories that then turned out to be not merely cyclical, but actually one-off plays on the pandemic. Something like that has never happened before. That's why so many of us got it wrong. It was almost impossible to forecast. But in an uncertain scenario, companies will typically err on the side of having more product and making more product, not less. When you go that way, though, you run the risk of overproducing, and that's precisely what happened to tech. As one by one, companies recognized that the internet, which had been put into hyperdrive, switched back to something resembling, say, simple drive. Suddenly, there was too much supply coming and not enough demand for everything tech. Then out of nowhere, China locks down its economy to deal with COVID because they bet on the wrong vaccines. And then Russia invades Ukraine in a psychotic war of aggression. Both bad news for the industry. We're all familiar with tech. It impacts us every day, from the cell phone to PC, e-commerce. But analysts and companies alike came to believe that previously fickle consumers had then turned into serial gobblers of all things tech. FinTech, right? I mean, like the PayPals of the world, Logitech, which we like very much, but you had to have their gear. For some companies, the seemingly insatiable consumer exceeded the tepid enterprise market, which is usually much, much larger. So in other words, the consumer market looked like it was bigger than the enterprise market. So everyone built and built for them. And then out of nowhere, it almost all reversed. The consumer was full up. The enterprise needed to catch up. And China's switching to a vaccine-based system rather than a lockdown-based system. Now there's a glut of unbelievable proportions for consumers and a true dearth of product for the enterprise. So all of tech plummeted because everyone, again, from the companies to the portfolio managers to the traders, were caught with their pants down. Everyone had too much of everything. Making things even worse, of course, the Fed had to take into account the headlong boom, not the crash, and has tightened aggressively to stamp it out. In that environment, in retrospect, it seems pretty obvious that tech stocks would be wiped out, which is why I went so negative on most of the group last November. But what wasn't obvious, though, was that the analysts and commentators would only realize what was happening, what I just told you about, just now, not back in November. But now, near the bottom of the cycle, yeah, they finally becoming negative, just when I believe that they should be going positive. And that's how the semiconductor stocks exploded this week after Micron came on Squawk on the Street Tuesday morning to talk about how the enterprise is getting stronger and the chip glut will soon be worked off. All people heard about was the consumer side this week. Hey, it didn't hurt. Samsung came out last night and said things aren't as bad as we thought. Although instantly people said that the quarter was bad. It wasn't. And I wouldn't be surprised if this sparks a much more lasting rally in tech. Why do I think tech now has staying power? Because first, the Chinese consumer might be coming back. But second, more importantly, the enterprise isn't getting as weak as you normally expect in a Fed-mandated slowdown. And in many ways, tech is helping businesses manage the downturn as it always does. Tech's deflationary. You can lay off lots of people with new technology. You can figure out how to make things more cheaply, do more with less tech because of technology. You can make better products with more tech. All of this is happening now. The smokescreen of the consumer's tail off obscured an underlying rise in corporate demand that's now playing out fast. As someone who's seen many a cycle, I know that you can't wait for the inventories to burn off or online advertising start coming back. You have to anticipate the turn when things look really bad, like right now. That means most analysts who only turn negative right here will be wrong. They're 7 months too late. Remember what tech's role in society really is: to improve an enterprise or a consumer's life with something faster, less wasteful, more intelligent, and more helpful. The enterprise needs 5G wireless and high-performance computing more than ever to keep up with demand. It doesn't need more PCs or printers or low-end cell phones. It needs top-notch cybersecurity, not grafted on hardware. The bottom line: you need to recognize that tech could have more than just a temporary bounce, at least if you're looking at companies that provide new life to the enterprise, even as, admittedly, the consumer side still looks pretty ugly. Harriet in Florida. Harriet.
Hello there, Jim. Hey, Jim, I've held on to my shares of Dick's Sporting Goods, which, of course, are underwater. But I was wondering, what are your thoughts on specialty retail and DKS in particular?
Okay, I happen to like Dick's more than I like the specialty retail group. And one of the reasons I like Dick's is that I think that Lauren Hobart is fabulous. This stock sells at 7 times earnings. I almost think it's like sexism that it sells at 7 times earnings. I'm not kidding. There's no reason why that stock should be so low. And I invite Lauren Hobart to come on any day of the week because she's a fabulous manager. All right. You need to recognize that tech could have more than just a temporary bounce, at least if you're looking at companies that provide new life to the enterprise, while the consumer side, I'm not saying it is good. It's still ugly. On Mad Money tonight, speaking of the enterprise side, C3 AI had a strong showing this week. So could the enterprise software stock be ready to continue its run? I'm going to talk to the CEO. Then is it time to get defensive if you want to with a stock like Coca-Cola? I'm taking a closer look at the stock. And Levi's reported second quarter results after the bell. I'm running through the numbers fresh off the release with the company's top brass. They look pretty good. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.